Welcome to another episode of OPTO Sessions. Please welcome Matt Hougan, the Chief Investment Officer at Bitwise Asset Management, creator of the world's first and largest crypto index fund. Previously, Matt was also CEO at ETF.com. How's it going, Matt?
Doing great. Thanks for having me. Really excited to be here.
It looks pretty sunny there. Is it? Where are you calling from?
Yeah, outside of San Francisco. I'm in Berkeley, and it is a perfect day outside. Just blue skies and birds chirping. So I'm enjoying it. Yeah.
Are you mainly based there, or do you travel around a lot?
Mostly I'm based in seat 21D of United Airplanes, it seems like. I travel around a fair amount. But this is my home base. This is where I come back to.
Paul and Panda always knew the summers were getting warmer, which meant the building's AC would be tested. But Paul and Panda always knew that drones were cool. And now they can grow grapes on the roof. Foresight's a wonderful thing. Invest in innovation, including drones, with OPTO.
Just for people who don't know, can you give us a quick overview of Bitwise and what sort of products they offer in the market?
Yeah, love it. Bitwise is a specialist crypto asset manager. We started in 2017. So we've lived through 7+ years of bull and bear markets. We manage something like $3.5 billion of assets here in the US, all focused on the wealth management market. Our two flagship products, we have one of the larger Bitcoin ETFs, BITB, which has $2 billion plus in assets. And as you mentioned, we have the largest crypto index fund, the Bitwise 10. But we also run 18 other strategies, everything from DeFi index funds to NFT index funds to active strategies. We aim to be the specialist crypto asset manager for US professional investors. And, so far we're off to a pretty good start.
Yeah, congratulations on the Bitcoin ETF launch. That was a big success there. So yeah, I mean, it's been a really interesting year for crypto blockchain. Obviously, total market cap for crypto assets approached all-time highs recently, nearly at 3 trillion this year. We've also had the Bitcoin halving, where the reward for mining new Bitcoins is cut in half, a big event for Bitcoin every 4 years. You've commented in this on Twitter and given a good response. So I thought we could bring it up because a lot of people have been asking about, is the Bitcoin halving priced in or not?
Great question. I think ultimately the answer is no, but there's an important nuance to it. So efficient markets theory would tell us that a well-known event should be reflected in the current price. And there's no event that's better known, I think, than the Bitcoin halving, right? We knew that this was coming back in 2009. It's literally written into code. We didn't know the exact day, but we knew that this day would come. And so you would expect it to be priced in. And I think you see that in the short-term reaction of prices to the halving. It's not like prices went up or down substantially on the day that the halving occurred. The market just continued. So from a local perspective, it's priced in. But what I mentioned on Twitter, which I think is what the market misses, is that the halving does change the nature of the Bitcoin market. There are two types of sellers in Bitcoin. There are people that have to sell and people that can sell if they want to. The Bitcoin miners are the only people that have to sell because they spend a lot of money mining Bitcoin, and then they have to sell the Bitcoin they mine to cover those costs. What the halving does is it removes half of those forced sellers from the market. So almost all that's left are people who only sell if they want to. And the reason I said it's not priced in is that it's priced in to the extent that the market is forecasting what the demand will be. But if the market is wrong, if there's more demand than the market expects, well, then that sort of surprise has to interact with this new market, which is different than the market before. It's a market that's dominated now by people who don't have to sell if they don't want to. And I think what you've seen on past halvings is, look, the price never moves much around the halving itself. But if you pan out a year, the price has gone way up, right? 8,000% after the first halving, 200% and 500% after the second and third. And that's because I think the market misestimated demand. There was more demand than they expected. And then it was chasing it only from people who didn't have to sell. And I think that's going to happen again. I think the market dramatically misestimates the amount of demand we're ultimately going to see from the advent of ETFs. And I think when that demand comes into the market, it's going to have a hard time finding Bitcoin to buy. And I think that should be positive to price. But, just one man's view of what's going on in the market.
Yeah. And why do you think this is going to be one of the most impactful halvings we've had to date? What's different about this one?
Yeah, because there is both a demand shock and a supply shock going on at Bitcoin at the same time, right? Bitcoin's ultimately a commodity. Its price is set by supply and demand. The halving is a supply shock. The amount of new supply falls in half. And we know from studying whatever commodity you want that when there's a supply shock, it tends to be positive for price. And that's indeed what we've seen in Bitcoin historically. But at the exact time we're getting this 50% supply shock, you have a demand shock from the ETF, right? These ETFs are the fastest growing ETFs of all time. I know that some of the flows have tapered off for a while, but I expect them to rebound and accelerate, in the second half of the year and beyond. So you have a demand shock and a supply shock at the same time. And I don't think we've ever seen that in the history of commodities. I mean that literally. We've seen demand shocks. The advent of the automobile creates huge demand for gas. We've seen supply shocks. Tensions in the Middle East reduce supply of oil. But we've never seen both of those things pulling in opposite directions at the same time. And if I'm right about that thesis, it could be a very exciting, 18, 24, 36 months.
So let's talk about the ETF. And like, as you mentioned, the flows tapered off a bit over the last month or so. Any idea of why that's happening, and also what you think will happen throughout the next 6-12 months? What you mentioned, you think they're going to go up, but any sort of catalysts that you think are going to spur that forward?
Yeah, 100%. Bitwise has been working. Well, I should back up. I think the primary audience of ETFs ultimately is financial professionals, not retail self-directed investors, because they can buy through Coinbase app or whatever.
Yeah.
But financial professionals. Bitwise has been working with that market for 7 years. What I've found in working with that market is the sales cycle is long. It's 6 to 12 months. You have an initial meeting. Okay. They ask you if the government's going to ban Bitcoin. You have a second meeting. They ask you how to value Bitcoin. You have a third meeting. They ask you about the environmental impact. It's only the fourth or fifth meeting at which they're ready to invest. And then they build their exposure over time. Maybe it's 6, maybe it's 18 months. I think what happened is there are a lot of people that sort of built up demand for the ETF before it launched. And we saw this huge rush of flows from those people who had done the work before the ETF launched in order to be ready to buy when it launched. But now that money has come in, and now we're waiting for the people who started their due diligence process when the ETF launched to be ready. Some of them can't even buy it. If you're at Morgan Stanley, you can't yet buy it. It's not approved. That's going to happen in Q3. If you're at Wells Fargo, you can't yet buy it. Other people who just woke up, oh, there's an ETF, I should start the process. They're going to be 6 months from launch, 12 months from launch, 18 months from launch before they launch, they allocate. So I think the ETF soaked up all the prepared demand, and the sort of cultivated demand is a 6 to 18 month story. And so I expect in Q3 and beyond, we'll see flows come back and even accelerate.
And how much of the demand is, we've got the IFAs, is that right? I think in the States, but also you've got family offices, you've got the institutions. What do you think the split is going to be? Do you still think it's primarily the financial advisors, wealth managers that are going to create the demand for these products?
Long term, I think the largest single market is the financial advisor market, the IFA market, plus the broker-dealer market at places like Morgan Stanley. I do think we're seeing substantial inflows from family offices and multifamily offices. And I think we'll see institutions come in, but I think that will be further down the road. If you look at the initial demand, I do think there's a lot of retail investor demand in there. But ultimately, the people who are going to buy the next 50, the next $100 billion of these assets, I think those are, IFAs and family offices first and foremost. That's a huge market in the US. That's like a $40 trillion market. So there's plenty of firepower there if they decide to come in.
And if we're talking about the long-term drivers of price, this is obviously one of them. What about, because a lot of people are talking about inflation expectations. What are your thoughts about that? Do you believe that's a driver of the price long term?
Yeah, it's all tied up in this. When I talk to financial advisors, one of the primary reasons that they're investing in this is that they're worried about inflation. Look, these people serve very wealthy individuals. These are individuals who have enough money that they're not going to spend their way to poverty. Sort of the only real long-term challenge to their financial security is significant, persistent, or shock inflation. And so I think you're going to find a lot of those people who want a small hedge, and Bitcoin is the most effective hedge against long-term inflation that I've seen in the market. So I do think there's rising worries about that. I mean, look, the US is running multi-trillion-dollar budget deficits, or more than $1 trillion in budget deficits, at a time the economy is booming. That's sort of a recipe for continued inflation. So I do think there's a growing concern about that here in the States.
Yeah, I mean, we had yesterday, today's Thursday the 2nd, yesterday was the Federal Reserve meeting. We obviously kept rates the same, and we're discussing quite a bit about quantitative tightening and changing their sort of approach to it. Do you think that's going to change in the next 6-12 months before the election? There's sort of will we have rate cuts? Will that be potentially one of the triggers for risk assets getting a bit of a bid again?
Yeah, great question. My base case is that there will be no rate cuts through the end of the year. I know that the market slightly disagrees with that, but I look at the economy that's running pretty hot, inflation running pretty hot. I know that rents are going to are a trailing indicator in inflation. Those are going to come down, and we've seen some tick down on commodity prices over the last few days. But broadly speaking, the U.S. economy is doing exceptionally well, and I think Federal Reserve officials wake up in the morning hoping not to be the person who lets inflation become untamed. So I suspect no rate cuts, but I think Bitcoin can rally right through that. I don't think that's going to constrain Bitcoin's rally one way or the other.
And we're talking about the inflows from the ETFs. Obviously, the first month or so, the inflows were huge. I think it's one of the most successful, if not the most successful ETF launch of all time. Correct me if I'm wrong. Obviously, you know a lot about all the ETFs. So how big a percentage of total ETF flows do you think in the future could be allocated to this sort of new asset class that's been created?
Yeah, it was the most successful ETF launch of all time by a significant measure. Just to put numbers on that before we make long-term estimates, these ETFs brought in a net $12.5 billion in their first 3 months on the market. By context, before these ETF launched, the most successful ETF of all time for a year one launch was the QQQ ETF, which invests in NASDAQ stocks. And it brought in $5.3 billion in its first year. So these ETFs did, 2.5 times that in 3 months.
That's mad.
It's simply unprecedented. Yeah. Long term, I think these could be, between 1% and 5% of the US ETF market, which is a $7 trillion market. So I think this is a multi-$100 billion addressable market in the US alone. And that's at current levels, right? That the ETF market will grow. So I think these will end up owning a lot of Bitcoin. It's already arguably the single cheapest way for most professional investors to get exposure to Bitcoin. It's a tremendous deal. And I think these ETFs are going to have collectively hundreds of billions of dollars.
And if we're talking about ETF flows as an indicator, do you think that's a good thing for people to follow in terms of giving the indication of demand? What percentage of demand currently comes from the ETFs when compared to overall, demand for Bitcoin? I don't know if you know that at all.
Great question. I do think it's a good indicator. I would encourage people to follow it on a long-term basis and not overreact to 1 or 2 days of inflows or outflows. If you look at the closest analog, the gold ETFs, which launched in the US in 2004, they had inflows and outflows all the time. But year after year, the total net flows grew from 2004 to 2005, every year through 2011, when they collectively owned over $100 billion of gold. So I think these will build over time. And I think if you have healthy month over month or quarter over quarter flows, you should be optimistic about where this market is going. So, I think that's probably the right way to think about it. Just keep it in the long-term view.
Yeah, that makes sense. And I think you've discussed on Twitter that the ETF has got the potential possibly to create a price floor in Bitcoin and also reduce volatility. Can you take us through why that may be the case?
Yeah, as these ETFs come to own more and more of the Bitcoin market, and right now they only own a small fraction, right? 1% of all Bitcoin, give or take, for the US ETFs, a little bit more than that, but in that direction. But they represent a lot of the new demand. It's hard to say exactly how much, but I think they're the primary driver of net new demand. The thing that makes Bitcoin ETF investors different from traditional Bitcoin investors is they tend to be more professional investors who manage their Bitcoin exposure within the context of a broader portfolio of stocks and bonds. And when you manage a portfolio of stocks and bonds, one thing that you do typically religiously is you rebalance. So you have a target allocation. Maybe it's 60% stocks, 40% bonds. Maybe now it's 55% stocks, 5% Bitcoin, and 40% bonds. If those allocations get stretched, then you rebalance back to them at the end of the quarter or at the end of the year. And what this creates is a sell high and buy low discipline, right? Because if the market rallies, Bitcoin will become more than 5% of your portfolio and you'll have to sell it. If the market falls, it'll become less than 5% and you'll have to buy more. And I think that rebalancing discipline will work to counteract some of Bitcoin's historical volatility, because retail investors often chase price. Now, it doesn't mean Bitcoin's going to be boring. I'm not worried about that. There's going to be plenty of vol. But I think on the margin and over time, and increasingly over time, this will constrain the volatility to a reasonable degree. I don't know if that'll show up this year, but by next year, the year after, I think you'll start to see this effect really kick in.
Yeah, that makes a lot of sense. So turn them more into a big cap stock rather than a small cap. And we didn't discuss earlier, do you think, so you've got the IFAs, what about any major banks? Do you think they're going to get involved in Bitcoin at any point in the future, or is that something that's a step too far for them? Because they've got large holdings of gold, as far as I'm aware.
Yeah, I mean, I think there are two different kinds of banks you can talk about. Ultimately, I think central banks will eventually put Bitcoin on their balance sheet if we're talking about, sort of the largest centralized institutions, for the same reason that many of them hold gold. I think they'll want to hold Bitcoin. I wouldn't be surprised to see that within this cycle, the first allocations from central banks. When you get over to sort of Wall Street level banks, I think what you're going to see them is providing trading services and custody services and other services into this market. But they're not going to take, fixed long positions in Bitcoin. But I do think traditional Wall Street is coming into crypto. I think the first place they're going to come in is actually through the stablecoin market. But as they do that, I think they'll start to provide more and more services. So central banks eventually, yes. Wall Street banks on the service side. But make no mistake, Bitcoin is moving from this out of normal, unusual asset more fully into the mainstream and being embraced by more and more people.
Yeah. You mentioned about stablecoins, that people are underestimating them by a factor of at least 10x, sorry. Can you just elaborate on what you mean there?
Yeah, I mean, first of all, stablecoins are amazing. I love Bitcoin, but not everyone wants Bitcoin. Stablecoins are a faster way to pay for things, and they're also a tool that makes US dollars accessible to everyone around the world with a cell phone. And that's an amazing service, particularly in economies that have high inflation or unstable regimes. The ability to access dollars and pay for things with dollars in those economies strikes me as a massive game changer. The reason I think people are underestimating them by a factor of at least 10 is they aren't thinking about what happens to that market once we get comprehensive stablecoin regulation, which it actually looks like we might get in the US this year. Despite it being an election year, there's a massive bipartisan effort to get comprehensive stablecoin legislation. And if we get that, we're going to see JP Morgan launch a stablecoin. We're going to see Citigroup launch a stablecoin. We're going to see stablecoins start to compete for traditional payments with Visa and other networks. Look, it's a much more efficient way for dollars to be stored and sent than the existing system. And it's also a global way. And I think if we get that legislation or regulation that opens up traditional Wall Street to this market, I really think it's a game over. I think 10x is maybe too small. I think it may be bigger than that. And I think we're going to get that legislation in part because there's so much money to be made that traditional Wall Street wants to do it. So yeah, I'd look at that as another major catalyst we could actually see this year.
And how would that interact with the government who want to maintain control? Obviously, are they going to have some sort of legislation or other controls over these stable coins to accept them? Is that what would be inbuilt into that rule?
Yeah, if you look at the draft of the rules that are circulating, there are a few things in there. One is that if you want to have more than $10 billion of AUM, you have to be a bank. Another is that you have to hold only cash or cash-like treasury securities, right? You can't do algorithmic stablecoins and call them stablecoins. These have to be effectively money market funds. And of course, there's more regulation surrounding them and AML KYC. For those reasons, there are actually lots of parts of the crypto industry that dislikes the bills that are circulating today because they're not as sort of freedom forward as the traditional stablecoin market. And I accept that as true. Just from an investment perspective and in terms of what it means for the crypto ecosystem, the impact is so potentially large that even though these are imperfect regulations, I think it would be a massive catalyst. So yeah. I really think it's a potential big deal.
And I mean, is this going to upend Visa and MasterCard's business models? I mean, I assume the transaction costs will be a lot lower for stable coins. What happens to those sort of companies? Or are they going to create their own and compete in the space?
Yeah, I think they're looking at it aggressively. Visa, as an example, recently launched a great online stablecoin monitoring tool. PayPal launched its own stablecoin, so they see the writing on the wall. I do think it fundamentally disrupts that market, right? You can't get away with charging 2.5% to move data over.
Yeah, it's a lot, isn't it?
It's ridiculous. It's absurd.
And it's a oligopoly almost as well.
It is an oligopoly, and it reminds me of like the old regulated industries when we used to pay $1 a minute for long distance phone call. And then all of a sudden, that broke and it fell to free. Payments should also be free. What is so difficult, right? I can sell a stablecoin for free and have it settle instantaneously. Like, why are we paying 2%? So I think that market is so ripe for disruption, and I think it'll be a huge win for people when it is disrupted, because it's $100 billion a year that we can sort of suck out of Wall Street and put in people's pockets with this better technology. I just think it's massive.
And what happens to the US dollar? It basically just be digitalized, essentially, is what we're saying, rather than it won't disappear. It's just it's an upgrade.
I mean, that's the funny thing. And that's one of the reasons I'm optimistic on this stablecoin bill is this is actually good for the dollar, right? Because it's exporting dollars around the world. You'll be able to use stablecoins in Argentina in a way that's hard to use dollars. And for this reason, the Fed and lots of Congress has actually rallied behind stablecoins because they've realized like, oh, this might be our chance to extend dollar hegemony another decade, before somebody else does this. So, look, I don't think the dollar is going anywhere in the next 10 years. This would actually help it sort of anchor itself around the world as a payment tool of choice.
And so just touch it. When was that bill coming out? Just something definitely to keep an eye on.
Yeah, definitely keep an eye on. The hope is that it comes through this year. There's a bipartisan bill in the Senate, which is more, the Senate is sort of natively crypto positive. The House is crypto skeptical, but the House Financial Services Committee Democratic chair recently said she thinks she's going to put forward this bill within the next few weeks, and she has buy-in from the White House and others. So there's no guarantees in Washington, particularly in an election year. It's very rare for major legislation to get through, but we could see something in the next month. We could see this legislation bubble out of committee and make its way toward the floor for a vote. And if we see that, I really think it might be a significant catalyst for the second half of the year.
Yeah, that is really interesting. Moving on to some predictions that you've talked about recently. I thought we could go through them one by one because they're quite interesting. So you've got 5 predictions before the 2028 halving. The first one is about Bitcoin and its volatility declining 50%. I just thought you could just explain each of these as I go through them.
Yeah, absolutely. This is what we discussed. I think the nature of the Bitcoin market is moving from a retail self-directed driven market to a professional investor market. And the big difference there is what we mentioned. One chases price and one rebalances contra to price. And I think that emergence is really going to tamp down volatility. It's also worth noting, broadly, Bitcoin volatility has been falling for years as it matures as an asset. So when you get both of these forces together, I think the volatility will come down 50%. It'll still be volatile. That's still a volatile asset, more volatile than stocks, et cetera. But I do think it'll come down.
And next, 5% allocations to Bitcoin will become common in target date portfolios.
Yeah, absolutely. Target date portfolios are so massive. That's where you pick a date, you need money. I need money for my kids' education in 2040 or whatever. And that's a balance of this much stocks, this much bonds, and then adjusts over time. Right now, Bitcoin doesn't exist in most of them, but I think as it goes mainstream, it will. And we're actually already seeing this in Canada, which had Bitcoin ETFs 2 years ago. Fidelity has allocations to Bitcoin in its target date ETFs or target aggression ETFs. And those allocations are between 1 and 3.5%. And I think that's going to tick up over time. Bitcoin is great in diversified portfolios historically. So I think we're going to start to see this. And there's substantial flows that will follow those, if I'm right.
And why have you picked out target date portfolios specifically? Are they just one of the largest types of portfolios? I assume IFAs are the ones that set them up for clients.
Often it's the fund issuers, right? So like BlackRock will have a target date fund. The reason they're so popular is so much of US savings is either through retirement or through college saving programs called 529s. And in those programs, most people don't monkey with picking stocks or picking funds. They just buy this target date allocation. Like, so for my kids' 529, I have a target date allocation. I never think about it. I just send in money every month and it allocates automatically. And that automatic allocation and automatic rebalancing, that's just where the money is. That's where the persistent investment from people's paychecks every month, that's where it goes in the US.
Yep. Okay, number 3, Bitcoin ETFs will gather $200 billion in flows.
Yeah. Well, we talked about this. I think they're going to hundreds of billions of dollars. I don't think that's extreme. Again, the US ETF market is more than $7 trillion. So
what are the flows at the moment, Matt? What are they? Back when we started, what are the flows into Bitcoin at that point?
I think it's 12 or $13 billion net. It's more inflows, but offset by GBTC outflows. So that's in a 3-month down payment. And, as mentioned, ETF flows have a tendency to build year after year. Year 1's actually usually challenging for ETFs. It's really year 3 and 4 and 5 where you start to get things really rolling. So I'm hopeful that we see that. I think that we'll see that. And actually, public estimates also agree with me that we'll see that.
Number 4, central banks will begin allocating to Bitcoin.
Yeah.
We
Look,
touched on that a bit.
we touched on that, but I'll add one more thing. One of the shock events, without getting into the politics of it, which I don't have a view on, but one of the shock events of the last 5 years was the U.S. seizing the Russian government's holdings of U.S. treasuries, and I think they had reason to do that, but that sends a message that holdings of international sovereign debt are no longer safe assets for central banks. And you're seeing a response already in that central bank purchases of gold have gone way up. But Bitcoin is almost strictly better than gold in that you can actually use it for payments. And it moves around the world and it can be stored infinitely free. I just think there's not a big leap to go from central banks buying a ton of gold, which they're doing right now, to central banks buying a little bit of Bitcoin as well. And I think the rumors we're already seeing it behind the scenes, but I think we will explicitly see it sometime in the next few years.
Do they have to tell everyone when they do things like this, or
No,
is it
no? I mean, it depends on the bank. Obviously, U.S. and other banks have certain disclosure rules, but I suspect we'll know it too. I'll pen that to my prediction now. I suspect we will know. It will happen, and we will know.
Okay, number 5. Bitcoin's price will trade above $250K.
Yeah. It's funny, when we post predictions like this on Twitter, no one likes that prediction. Everyone thinks it's way too high or it's way too low, right? No one likes Mr. In between. Look, we've looked back, Bitcoin moves in 4-year cycles, 2011 to 2014, 2015 to 2019, and so on. We're in the middle of another 4-year cycle. I won't get into the specifics, but broadly speaking, you add another digit every 4-year cycle historically.
Yeah.
It was in the hundreds, in the thousands, in the tens of thousands. It's going to be, in my view, in the hundreds of thousands. And where it gets to is maybe less clear. But I think 250 is a relatively conservative continuation of the historical pattern. There's no guarantee, but that's just my gut.
And historically, post halving, I think as the 4-year cycle goes, it's sort of 12 to 18 months after the halving that you get, a peak.
Yep.
I mean, there's been some variation in that. Now, everyone knows this, more and more people know this nowadays. So do you think that's going to affect what happens? Like, are people going to sell early because they know something is about to happen in the future? Or will all the new inflows from ETFs and new participants that don't know about this probably or possibly mean that it actually goes on further potentially than what it has done before?
Yeah, great question. The short answer is I don't know, but I have a sense on why it happens, which maybe makes sense. I think what happens really underneath the surface is that we have these massive bull markets, and in any massive bull markets, things get overextended and break. So like the first bull market, the thing that broke was Mt. Gox. We had a massive run up and the custodian was not willing to handle it. It broke and the market reset. In the second bull market, the 2015 to 2018, the thing that broke was just scams. We had a massive bull market, and then we had this ICO ridiculousness. The SEC shut it down and reset. If you look at the last bull market, 2019 to 2021, again, so much excess built up in the system, too much leverage, scamsters like Sam Bankman-Fried, right? Sort of a classic overreach, and we reset. So I think the real question is, if I'm right and we have this mainstreaming of crypto, how fast do we build up too much excess in the market that we get over our skis and reset? This is an economic tale as old of time, right? This is why economies go through booms and busts, bull markets and recessions. The same thing is true in crypto. I think it may take a little bit longer than historically to build up that excess because there's more regulatory rails and they're more established players. But, if we get a few years of multi-100% returns, you're going to see some nonsense build up into the market and it's going to eventually get cleared out and reset. So just keep your eyes tuned for total nonsense and you'll know when.
trouble is it can last so long, at least historically. It goes crazy, doesn't it? Sometimes. So
Yeah, that
very
is
hard to
right.
tell what is normal.
Yeah, it very much is. And things that seem unnormal become normal. It's hard. That's why my long-term view is just, buy, hold, and rebalance.
Yeah.
But look, I do think we'll get another bear market in the future. I don't think we've banished those to the hinterlands forever.
And moving on to some other cryptos outside of Bitcoin, can you touch on some real world use cases of other cryptocurrencies that maybe a lot of people don't know about, that shows how there's value in the other side of the space?
Yeah, absolutely. If you think of Bitcoin as a monetary asset, other crypto assets are more utility assets. You can build applications on Ethereum or Solana, the same way you can build applications on Apple's App Store. And I think there are a large number of killer apps being built on those ecosystems. I'll throw out a few. One, we mentioned stablecoins. Stablecoins are issued on blockchains like Ethereum, like Solana, etc. And without those blockchains, you can't have stablecoins. I think stablecoins are a many trillion-dollar market, and those are all built on Ethereum, on Tron, on other layer one blockchains. So I think that's a significant use case. I'll give you a few more. We saw BlackRock launch a tokenized treasury fund built on Ethereum, and it gathered $350 million of assets in its first month on the market. I think a lot of people assume we're going to see trillions of dollars of assets tokenized. When that happens, that's all going to be built on these blockchains like Ethereum, Solana, etc. And so if you're into tokenization, that is another play. We're also seeing... go
Sorry,
ahead.
Matt, what is the benefit of the tokenization there, just to touch on that a little bit?
Yeah, there are a few. I mean, one, it trades 24/7, 365. So, if you want a treasury fund today, a treasury ETF, you can get one, but it only trades banker's hours. What if you need to use it on Saturday, Sunday,
Yep.
Monday? Another one is it interacts with the crypto ecosystem. And there are a lot of things in the crypto ecosystem that are interesting. DeFi applications, margin loans. If you want to get a margin loan on your treasury ETF, you have to sign a prime brokerage agreement. It takes weeks. You have to fund it. If you want to do it on your treasury, your tokenized treasury fund, you'll soon be able to do that on platforms like Aave in matters of seconds. So there's just more you can do with it. And ultimately it improves, settlement speed and cost. More efficient ecosystem. So,
and do you think that extends to things such as property, like property?
I think eventually it extends to lots of things. Yeah. Look, I think it's going to take a while. I have a long-term view of tokenization, which is that we're still many years away from it being utterly massive, but we're already seeing these sort of proofs of concept. So I do think it extends to property. And I think the unique liquidity aspects of blockchain means you can go further down the chain of illiquid assets. To some degree, I think it's inevitable that we will get there.
And just coming back to the real world use cases,
Yeah.
Render, I think it's another one.
Which one was that?
Render.
Oh, yeah. I mean, Render's a great example. So what Render is sort of a decentralized network of compute that you can tap in to render 3D graphics. Rendering 3D graphics is very compute intensive. It's hard to do on your laptop. It would take days to render a major graphic, but you can outsource it either to cloud services, Amazon, Azure, etc., or Render. And what Render does is it uses blockchains and token economics to tap into unused graphical processing capabilities on computers around the world, aggregates those up. So instead of paying Microsoft, you can pay a decentralized system. And people are using it to do things like render graphics for the Sphere in Las Vegas. What I like about the Render example is it's not a classic financial example, right? We talked about digital gold, we talked about tokenization, we talked about stable coins, but you can use blockchains to coordinate economic activity in other non-financial applications. Render is a great example of that. There's no way to do that without a blockchain and a crypto token And I think it's a cool example. It's growing. It's an idea. I think it may succeed.
It's really interesting to see these sort of things get traction.
Yeah.
Obviously, they need to get big enough. A lot of these to show massive utility, but a lot of them are showing early signs. Is it very interesting?
That's right.
Just another question related to the Bitcoin sphere, but no, there's cryptocurrency spheres. Is Bitcoin miners previously have been like a proxy for Bitcoin, or like a high beta proxy. Do you think that's still the case nowadays? Or do you think that things have changed since the launch of the Bitcoin ETFs, which are, because they lacked a product like that in the past, that people used proxies such as MicroStrategy, the miners, to get allocations to Bitcoin via the stock market?
Yeah, I think it is changing. I think many of those companies are very interesting as companies, but I don't think people are reaching to them in the same way as proxies. We've seen this in the past. We saw this with gold. Before the gold ETF launched in the US in 2004, the only way traditional investors gained exposure to gold was by buying gold mining companies. And they bought those gold mining companies as sort of proxies for owning gold. And after the ETF launched, you saw mining companies lose that natural investor base and start to be valued and start to be run more as traditional companies, right? Focused on profit margins, their capital utilization. And I think you're seeing that in the mining space, right? If you listen to mining calls now versus in the past, they're all about, are we able to sort of source the lowest cost electricity? How is our install doing? How are we dealing with the lack of availability of cutting edge chips, right? They're traditional company problems. Now, I think those companies can be extremely interesting investments, but they have to be valued as companies based on execution and less about proxies based on Bitcoin's price, even though, of course, they still have a beta to that price. But I do think they're sort of changing a little bit.
And then lastly, before we wrap up, Ethereum is something I wanted to discuss, which has obviously been getting a lot of flack over the last, 6 months or so, just because it hasn't been performing like people probably wanted it to. Do you see that changing in the future? And that's just the classic sort of down before it sort of breaks out and gets its sort of shine back, because it's a big ecosystem. A lot of people use it. There's still a lot of utility there. What are your thoughts on it?
Yeah, I think Ethereum's been sort of squeezed in a narrative vice. On the one hand, you've had Bitcoin ETFs sort of soaking up all the crypto oxygen in the room. And on the other hand, you've had sort of Solana and alternate layer one solutions saying we're better than Ethereum, we're cheaper, we're lower cost, etc. And so Ethereum was sort of like squeezed between those two. And I think that's been reflected in its price. I bet the market is misestimating ETH. I think they've actually done a pretty good job through the rise of layer twos and sharding to solve their core problem of throughput and cost. And we're still seeing, when BlackRock, as an example that I spoke about, chose to launch a tokenized fund, they chose to do it on Ethereum, right? They couldn't do it on Bitcoin. They didn't want to do it on Solana. They chose to do it on Ethereum. And I do think its network effect, its largest number of developers, et cetera, I think it's well positioned, right? It is still the blue chip layer one solution, and its technology is evolving. And look, our approach is index it, own them all. But I do have a special place in my heart for Ethereum.
It's very hard to get, like you said, the network effects to get that to that size. It's just extremely hard for any blockchain to do. And so very few are probably going to get there, are they?
100%.
So ETF, are you able to touch on the, is it the potential of an ETF for ETH in the future?
Yeah, I have to dance with the compliance genie here. I can't speak to my specific ETF filing because we have a filing at the SEC. Yeah. But the big question is, will they get approved in May? Because that's when the SEC has to make its first decision on an ETF. ETFs run on a calendar timeline, 240 days, and the first one comes up later this month. I think the market is expecting that ETFs will be disapproved. Bloomberg puts the odds below 25%. And I think, that's probably the right consensus bet. Long term, look, I think we've entered the ETF era of crypto. And I think long term, we're going to get an ETF approval on Ethereum. There are already Ethereum futures ETFs. Futures track the price of spot. I think it's hard to argue we shouldn't have spot ETFs. So I think we'll get there. But the market is not optimistic in May. And I think that's a reasonable approach for the market to take.
Well, thanks, Matt. This has been really interesting to dive into Bitcoin and other cryptos with you. It's always interesting to talk about space because it's getting popular again and definitely timely to talk about it. Is there anything you'd like to talk about before we wrap up? Anything about Bitwise? Where can people go to find out more information about your products and also follow you and your insights on Twitter?
Yeah, absolutely. First of all, really enjoyed the conversation. So thanks for having me on. Yeah, check us out at bitwiseinvestments.com. You can sign up. I write a CIO memo every week. You can sign up to get that in your email box. It's usually short, only about 500 or 600 words, so I won't overwhelm you. And then, follow me on Twitter. It's Matt_Hougan, which is HOUGAN. So it's got that funny little U in there. But I'd love to see you on Twitter as well.
Cheers, Matt. Thanks very much. Have a good rest of the week.
Thank you.